All right, we are starting to welcome people into the show. Thanks for joining us. Welcome, everybody. If you're watching us on Facebook, hello. So for those of you who are here attending live, this is an interactive experience. Pretend this is as if you were actually at an event and say hello in the chat, mention where you're from. This is a community of people who want to help one another out. So drop in things that you might be looking for help on or things that you'd like to help one another out with. My name is Aaron Price. I'm the CEO of Tech United New Jersey. Very excited for today's discussion and this incredible panel for today's webinar on the current state of play in FinTech, what we've seen in 2020, maybe if we have time for it, which we probably won't, some predictions on 2021. We've got an incredible panel. We've got Andy Gilbert, who's a partner at DLA Piper, Kelly Ford, a general partner at Edison Partners, Noah Cooper, an SVP of Capital Markets at Cross River, and Dee Choubey, the CEO of Moneyline. I'm going to hand it over to Rini, who's going to, I'm sorry, I left off Rini, the Client Development Executive at DLA Piper, who's going to lead the discussion. Really appreciate you joining us today, and also want to thank Cross River and DLA Piper for sponsoring today's event. Everybody, thanks so much for being here. Usually I end with the high five, but I think we're going to start with the high five. So maybe on the count of three, you can high five the camera. 1, 2, 3, boom. We might do it again later, get a little crazy. Andy, whenever you're ready. All right, guys, thanks a lot. I'll be back at the end, and I'll be monitoring the Q&A. So if you have questions, drop them in the chat, and we'll bring them back in later on. Thanks so much, everybody.
So thanks, Aaron, and thanks to all the panelists for joining today. I wanted to start off talking about the state of the industry. And so I guess the first question for whoever wants to take it is, in terms of the current health of the FinTech industry, was wondering, what's your take on sort of, where we are, what was the initial impact on the ecosystem as a result of COVID, and where are we now?
Yeah, I can jump in there. And from our perspective, we're tracking loan performance very closely, specifically those in the unsecured consumer space. And the metric we're really looking at is payment impairment. So looking at the sum of borrowers who are delinquent and borrowers who've entered into some type of extension or forbearance on their loans. And the reason we look at the two together, it's often sometimes difficult to tell which loans would have gone delinquent if they had not otherwise entered into some type of payment program. So pre-COVID, we were sitting roughly at around 4 to 5% in that payment impairment number. During the peak of the crisis, we got all the way up to around 15 to 16%. So really a major spike. And now we're probably back down to somewhere in that 7 to 8% area. So really, almost like a 3 to 4x spike. We're back down to that sort of 8% number. So we've actually seen a 70% reversal in those payment impairments from the peaks. And while I know it's not a perfect comparison, if you look at the peaks of unemployment to where we are today, that has recovered around 50 or 60%. So one could broadly say that the performance of the unsecured consumer space within FinTech have outperformed the economy at large.
Yeah, there's multiple measurements of health, right? Like if you look at financings, like it's pretty healthy. I think, there's 12 billion in FinTech financing volume in Q3 and was I think third largest quarterly volume ever. And deal count was up too, I think like over 450 deals. And there's been really large financing rounds. And I think 40% of those financing rounds happened in Q3, this year, 40% of the years in Q3 this year. I think you can also look to IPO market, that's been really active. 22, I think, global FinTech IPOs. And, majority of those happened in Q3 alone too. So that's another lens of looking at, FinTech health, even in spite of the pandemic.
Yeah, Kelly, I think you guys both hit on one topic though, right? Which is there are multiple subsectors within FinTech, right? And so certain sectors are stronger than others. And at least our experience is that certainly in payments and money transfer, those industries are killing it. in the COVID world at the moment. In fact, expanding and growing quite a bit, and you're seeing certainly consolidation as there's a lot of M&A in those subsectors. Others are struggling, to Noah's point, right, which is in alternative lending and certainly in kind of the digital currency space. Obviously, other subsectors struggling a little bit more than they were pre-pandemic. So this is not one industry, right? This is a conglomerate, an aggregation of a number of different subsectors.
Yeah, I think there's been, and maybe Noah might have a view on this too, like if you just looked at funding in the market again, like banking and lending tech has been really active. But, and there's been really large rounds and some big names doing some, raising some impressive dough. But when you look at that category, like I know, because I've looked at a number of these companies too, that the banks are the customers, right, of a lot of these fintechs. And like they have these relationships with these banks, but the backlog on these implementations or the next wave of an implementation on some of this banking and lending kind of enabling technology has really slowed down for those, for those fintechs. So there's kind of dynamics impacting revenue coming online with some of the software providers and the platforms, because the banks have had to kind of reprioritize a bit, right? Like to what Noah was saying and what they've been focused on during the pandemic.
So I guess in terms of a couple follow-ups, with regards to the consumer, Noah, you talked about sort of how, there was a peak in terms of, some distress seen in consumers, and now that's subsided. I guess what do you think has really made a difference in terms of those consumer facing businesses? Why have they, not, sort of, declined, or why have they been more resilient, you think, in this sort of market?
So obviously we've had a healthy amount of stimulus, and it would be naive to say that hasn't played a large part in keeping a lot of these folks afloat in terms of their monthly payments. But digging a little deeper, I think the consumer is in a much different place today than they were in 2007, 2008. Overall, the consumer is much less levered than they were. Their balance sheets are much more healthy. And then I think the way that the underlying platforms are pricing risk is just much more appropriate than it was, 10 or 12 years ago. There's a lot more verification into things like income, looking at really not just what does that borrower look like today, but where is that borrower trending over time. And I think if you add those things together, it really speaks to not just the state of the economy, but also the wonderful job that fintechs have done in responsible pricing and underwriting. A lot of the models that we have are calibrated back to that last crisis, and I think we've been pleasantly surprised with the resiliency of the consumer.
And
I
Kelly,
mean, maybe Dee could add to that too, in terms of kind of the mobile first consumer and some of those dynamics. I think I saw a stat, and Dee, tell me if this makes sense in terms of what you're seeing with your customers, but that during the pandemic, like mobile banking usage in general and the adoption of even new products and services has been through the roof, like 50% growth or something.
Yeah, it's a good point. Look, I mean, I think the tensile strength of the American consumer was put to test, and there was some resilience in there. Now, we had some of the largest Keynesian economics, examples of Keynesian economics that the world's ever seen. I guess the U.S. was 11% of GDP in terms of stimulus. The entire Western world did that. So I think that was a good point that was just made around that. But really, all of the themes that we've been talking about as entrepreneurs over the last decade around fintech and convenience, access, data access, consumer choice, all of those themes really accelerated over the pandemic, right? I mean, the American consumer was stressed like they haven't been since probably World War II, right? There were earthquakes, there were closures, there were job losses, there were furloughs, and there were a lot of regional shocks, right? There were shocks across America that were different from, other places, the South, the Northeast, the Western states. all had different flavors of the pandemic, right? So in our data, what we saw was our competitive advantage. Now, we grew faster than ever through the pandemic, and we saw some of those themes that were playing out before that were taking 5 years or 10 years to play out. We actually saw acceleration of that in terms of mobile being the way to acquire customers and then to retain them. And from a credit perspective, if a lot of incumbent institutions still rely on fairly archaic ways to underwrite, fairly archaic ways to provide credit. What we also saw in the pandemic was that the resiliency of the consumer, and again, I think the point was made that they were different from 07 to 08. What was different also was the fact that even if you got furloughed, even if you lost your job as a consumer, the gig economy and the liquidity pool in your ability to kind of go do side hustles or gigs is probably greater than it's ever been. And we saw that in our data, and we responded very quickly with our algorithms when we provide credit to be able to give a consumer the benefit of every hour worked, not just at the W-2 spot that they have. We saw lots of issues in Michigan, for instance, with Ford, GM, and all the auto manufacturers furloughing consumers. Automatically, we were in a better position to provide them credit because we were able to take a long-term view from the data that we were seeing. The ability to provide stimulus faster than the banks. I know Cross River has done an excellent job in that area on the SMB side. We were able to offer stimulus a week or two earlier to our consumers on the consumer side. And that really won hearts and minds. And when we were able to do that, then of course the consumer, for us as a neobank, the paycheck is the most important thing that happens for our consumer. And we want to influence decisions made around the paycheck. It really accelerated us becoming a primary bank account for more and more sort of segments of our consumer base.
And Kelly, I think you touched on sort of the theme around digital transformation of sort of incumbent businesses, and then also just demand for things at the enterprise level. How do you sort of see demand for B2B, FinTech companies, sort of how are you guys looking at the future?
It's, we've been pretty, like the characteristics of the companies where we invest has remained constant. Our criteria has remained constant. I think, we focus on FinTech and some key areas of that, but enterprise SaaS, healthcare technology, like the areas in our themes really didn't have a lot of exposure. Enterprise SaaS, yes, slower sales cycles, implementation cycles, things like that. But, the portfolio overall, I think has performed well under the circumstances in FinTech. And I think companies have also just did the right things early, right? Like took the right measures to extend runway, to get back to basics, critical kind of fundamentals and metrics of their business, which are critical inside and outside of crisis. But, we really focus on growth and capital efficiency, and that hasn't changed. I think from a theme perspective, I think, Dee was saying just the acceleration of things that have that this pandemic has created has really, it's been pretty exciting for the themes that we were pretty excited about already, right? So just the theme of digitizing DIY, banking and investing, that's accelerating. Like we think about, hard economic hardship and student loan burdens and, really driving a shift towards savings and financial disciplines and the technologies that support that. Financial education and literacy, like starting to think about, millennial is a very important demographic, but, that next generation, how to invest, save, spend responsibly, the family's role in that, parents and families' role in that, so that they're getting ahead of it because they've seen this storm and how can they weather the next one for that next generation. I think that's remains an ever exciting, more theme. Tech-enabled millennials and Gen Z, they just demand more DIY and digitally enhanced financial services. And then I would say also on private market access, traditionally inaccessible asset classes like venture, PE, luxury homes, high-end art, they're becoming more accessible through pool vehicles and relaxed regulations. And, this represents an opportunity in FinTech, and we've placed some bets in all of these areas, and we'll continue to, to bet more.
Yeah, I think to follow up on that, I think as Kelly's point is, there is, the last of the adopters have adopted, right? And this crisis has really accelerated that almost across the board. You're seeing it kind of across each sector within FinTech. Those who are resisting it, whether it's B2B or B2C, I think the premise is all kind of borne out. Now it's just a matter of getting market share, I think, in many of these sectors.
Yeah.
Great. All right, so I guess just to shift topics slightly, Noah, you touched on sort of the impact government stimulus has had, in terms of supporting, demand. And I was just, I know Cross River was involved with, the PPP program, and I was just wondering if you could talk for a moment about, sort of the challenges in the last round of government stimulus, and, if you have visibility or you have perspective in terms of what, the next round is going to look like, that would be interesting, I think, for the audience to hear.
Yeah, for sure. And I think, while there certainly were challenges with the first round of PPP, in terms of perspective, there was, roughly $500 billion that were delivered to small businesses around the country in a matter of 4 months. And I think it's hard to argue that PPP wasn't an overwhelming success. And yes, there's bumps along the road, but trying to implement that size and scale of putting dollars directly into small businesses in that short of a time, I think it was success. And now I think looking forward, what do we see as the challenges on the horizon? Specifically with the Paycheck Protection Program, it's how do we go about actually getting those loans forgiven? That the process today, is a bit cumbersome. It is a bit lengthy, and I think we're often pushing for a more streamlined approach, especially for those small businesses, for them to be able to make certain attestations, get their loan forgiven, so they can go on to rebuilding their own business. So for Cross River's sake, we funded a little over $5.5 billion worth of Paycheck Protection Program loans, over 100 plus thousand individual small businesses, and I think our average business size, it was something around $40,000, and 95% of these folks were businesses with less than 20 employees. So we really want to focus on allowing these businesses to get through the forgiveness process and to get back on their feet and start rebuilding their business. If we look forward to really what is on the horizon, I do think there will be another program. It's sort of if and when is the big question out there. And our preliminary read, it's going to be focused on businesses who are experiencing continued hardship. That the first round was really focused on keeping those existing employees in place, and if you were under a certain size. But I think this go around may be focused more specifically on those businesses that are still struggling or not back up on their feet.
And then just in terms of practical advice, so if and when there is a second round of stimulus, do you have any sort of practical tips that you would give to the startup community, in order to maximize their chances to get a loan, and then also just to manage through that forgiveness process?
I would say work with Cross River. All kidding aside.
With a layup.
Yeah, exactly. Thank you for the beach ball there. I would say, given that we do think their focus is going to be on that continued hardship, just having all of your ducks in a row in terms of if you are indeed continuing to experience hardship and you had to lay workers off, or your revenues are reduced substantially without a reduction in rent costs or things like that, being able to really clearly document that and having it all up and ready. But like ourselves and other folks out there have really streamlined the process and made it more tech friendly and given folks the ability to interact really in a mobile first digital type environment, I think should make that process more smooth in a second go around.
Yeah, I actually think it'll be helpful that this time around, many small companies have already been through the forgiveness process, so they'll actually understand the kind of the back end of this. Whereas the first time, it was really had no idea, what that was going to be like. And I think eligibility questions are going to be answered this time around too. So there should be more clarity as well. But I agree with Noah. I think it's going to be a higher hurdle to prove need in this go around. I think the first go around was a bit of a mad scramble to get money into the system, and the underwriting was vague at best, and it left a lot of companies guessing. This time, and hopefully there will be a little bit more certainty for folks as they apply for these programs. I mean, the other issue with PPP programs now, frankly, is before companies that had received funds, before it's forgiven, that's actually impacting transactions, both M&A and even venture capital transactions, where these loans are outstanding. There's uncertainty as to whether or not they're going to be forgiven or not, and essentially, the sellers are bearing that risk, if you will, as to whether it's actually forgiven. So, money's being held in escrow in M&A deals on the sell side. So, that's something to think about that I don't think was really thought through by companies that were perhaps in the market to be sold, at the first round of stimulus. So if you're thinking that you're going to get a transaction done, you may want to rethink your application for a loan program.
Yeah, that's a good point.
Great. So maybe we could switch to another topic, which is sort of what's going on, in the VC and M&A, markets. And so, Kelly, I guess we'll start with you. In terms of, COVID and how it's impacted your investment process. I know you sort of said that, a lot of the themes are still intact, but, I guess in terms of how you look at companies, has COVID or, sort of the forecast become an extra diligence item that you run potential investments through, and sort of how has, sort of the last couple of months impacted sort of how you look at companies and how you evaluate them?
Yeah, I mean, our process, we definitely, I think there's a couple of things about how we operate that lend itself well to this situation we found ourselves in, but there was a lot of new ground that we were covering and decisions we were making around process as well. Like we tend to get to know companies for on average like 2 years before we invest. And it doesn't mean we're in diligence for 2 years, but like we like to get to know them early and track them. And we tend to be pretty thesis driven, particularly in FinTech. So it's nice to see their progress. We invite them to events, that relationship has been developing. So when they are ready, or, during this pandemic, if we were able to convince them to, that they're ready and to take our capital, doing everything online and not meeting in person was okay. I think at the beginning we said we wouldn't write a check of a certain size without meeting folks, but we wound up spending more time, I think, because everybody is just accessible, right? And it's easy to do it online. So I think that, from that perspective, our process changed a little bit. We're really focused. I mean, the same advice and expectations we had of our portfolio, we were having of the investment candidates, right? Like, make sure like these companies that are coming to us made all the right decisions, well, most of them, and the ones we look at seriously around runway and around assuming that they, you couldn't have assumed that you were going to raise capital this year, and you maybe shouldn't assume that you can raise it next year. unless, you're in certain hot space, there's a lot of capital out there. Like there are lots of investors wanting to put capital to work, but there's also, I think, the scrutiny around the health of these businesses to command the multiples that are being paid, because the valuation environment remains rich. But you really got to make sure, if you had tailwinds during the pandemic, you're not having a problem. But if you had to make some adjustments, you still need to show some smoothness and create a scenario for the business where you have optionality, both from a cash runway perspective, as well as just the fundamentals and the metrics in the business. So I don't know that maybe we've been more selective, but we're also constantly have this flow in this pipeline. We're also at the end of a fund, so we were going to be more selective there anyway. But I'm talking to a lot of people now that in actually doing real work, that deals that might not happen till February next year. And that's because folks made the right decisions around extending that runway. They have, they've modified their plans and their growth plans, and they put plans forward that were achievable. People were just smarter about it versus, we're growing at this clip, and I promise you, the next 12 to 18 months are going to look like this, and everybody kind of hopes for the best. I think we're in a position now, because people had been more responsible with their capital, their cash, and the way they were making decisions and choices they were making for their business, where if you are looking to raise money this year or the first half of next year, if you've done all those right things, you'll have that optionality. So I hope that increasingly we see more and more businesses who have been in that mindset and have received that advice from their existing investors or their board or their peers in the space. So that's less FinTech specific, and obviously it varies per sector where there may have been tailwinds or headwinds. But if you had headwinds, you better be kind of buckling down and really looking in the mirror and adjusting things to make sure you can kind of steer the ship to a point of health and repeatability that makes sense.
What's your experience been, from a company perspective in terms of cash management and sort of, as MoneyLion has sort of looked at sort of this environment and seen, opportunities, versus, I guess, the opposite, which is, you're always looking to preserve cash and preserve your runway. It's like, how have you sort of navigated, sort of those issues, and, sort of if you do convince yourself there are good uses of cash, what does that look like when you have to go to your investors and sort of convince them that instead of hanging on to cash, we want to reallocate it and go after, certain opportunities?
Well, it's a good question, right? So, this is something that we grapple with all the time. If you look at MoneyLion, we're a participant in parts of the FinTech industry that are getting a lot of capital, right? Neobanks, challenger banks, digital platforms, wealth management, digital banking. So, one view of the world is go get the largest user base and figure out how to monetize them later on, right? So that was the model of, I guess Internet 1.0, 2.0, Facebook, Google, kind of the 2000s variant. And some of our peers in challenger bank, neobank have taken that approach. They've gone and acquired a lot of users. So as a board, we decided that MoneyLion is actually going to more and more focus on unit economics, payback periods, looking at every single vintage of customers that we acquire. Are we acquiring the right customers? Are we getting the right payback on that customer? Or are we just opening accounts in the hundreds of thousands? At one point, MoneyLion last year was the 4th largest bank account opener in America. So we actually paused and said, is that the right strategy to drive a efficient business? So in a lot of ways, even before COVID, we took a bunch of measures that were focused, primarily on contribution margin positive products, really looking at our expense base. So when COVID hit, we actually, had extended our runway. We had the tough conversations with our board, with our investors, Edison and others, on really what that capital plan would be. And we got consensus that really, look, I think the way to build a sustainable bank of the future that's around for the next 5, 10, 15, dare I say more years, is really to focus on the right type of customer acquisition. So now, once COVID hit, we had the right unit economics, we had the right contribution margins, and then it was actually natural progression of the market from consumer demand that grew the portfolio, rather than really just kind of investing over and over and over again in performance marketing on Facebook or other channels that some of our peers do. And now, the cycle's kind of come back a little bit, where we're saying, okay, we're seeing great payback periods. The cohorts do what they're supposed to do. We're able to cross-sell our consumers from digital banking to wealth management to credit and vice versa. And then again, now's again the time to go back to the board and say, like, look, here's what we've been able to do with a lot of efficiency, and now let's have a conversation with where we want the growth rate to be. But if you think about, the middle of 2019, WeWork had happened. A lot of the, ride sharing companies had gone public, and the entire kind of feedback was get to profitability. But what you've seen through the pandemic now is, okay, you've gotten to profitability. Let's go, turn on the growth engine again. So it's really important for operators and entrepreneurs to, of course, have a big vision of having a large user base, but also marrying that and aligning that with the operating KPIs that they create discipline in the business as well.
Okay. So Dee, I'm gonna stay with you, because I think on the topic of financing, Kelly's right. There have been sort of a number of large financings, probably sort of skewed towards later stage opportunities. In terms of Moneyline, you went through that process of sort of financing your growth and getting to a point where you would be interesting to institutional investors. And I was just wondering, in terms of your own story, for the audience, if you could just sort of briefly talk about sort of how you were able to bootstrap to that point. And then I guess the second question is, in terms of financing, what advice would you give to sort of earlier stage companies that are looking to finance, particularly in this market?
Yeah, look, I think that, Moneyline, we've made probably a lot of mistakes along the way, but what's really worked is just finding product market fit. So if your consumers are giving you feedback that, hey, it's a high NPS product, that we love it, we don't churn, even if you find that with 1,000 customers, that you have something. And that's the platform really for then scaling the business, for growth. And that's really what we were able to convince our investors like Edison and others, that we had the ability to show product market fit in a couple of different areas in digital banking. First, around the credit need that middle income households have, then digital banking, then robo-advisory. And really that was our method and our evolution of building a user base that was large enough, that was loyal, that had an affinity to our brand, and then building more and more monetization engines around those financial inflection points that they have. As it relates to early stage companies, look, I think that the capital efficiency point that was made earlier is a really important one. The opportunity to build, product market fit, or get, the hypothesis tested in a capital efficient manner, is probably easier now than ever in the history of startups, right? I mean, the democratization of data, the ability to set up infrastructure on either Google, Azure, or Amazon are easier than ever. So really the advice now, if I had to do it all over again, would be to really, in a capital efficient way, prove out a thesis, prove out a need for customers, solve problems, all sort of the kind of best practices that we read about, and then go ask for the capital, and then go ask for the investors really to come in to scale that. But really the discipline around contribution margins, how will this business scale, really understanding that business equation of how the company makes money, what are the expenses, and really stress testing that in different scenarios. Stress testing demand in different scenarios just makes that conversation with investors that much more efficient and that much more valuable, because you have a lot of the data behind you. Because again, the investors are all very smart. They all want to look at vintage analyses. Just showing a regular P&L is never enough. You need to show that your cohort that you acquired in January has had such retention. They've increased their ARPU over time. And if you're able to do that, ultimately it comes down to just building a good product. And that good product could be, my point is, be built in efficient ways from a capital raising perspective in today's environment.
So I guess at the other end, sort of if you've raised capital, is hopefully there'll be an exit, an M&A or IPO. And so Andy, in terms of those markets, M&A and IPO, what are you seeing for fintech companies?
Well, it kind of runs the gamut, right? So certainly on the M&A side, we're working with a number of kind of PE-backed platform companies rolling up fintech companies like crazy at the moment. I think we've got about 6 of those at the moment that we're working with actively. So you're looking at it from payments or wealth management or in other subsectors of the industry. So certainly I don't think M&A slowed down at all, and it kind of goes to the capital is readily available and needs to be deployed point that folks have made already. Valuations are certainly, frothy, and I think, the PE firms and the strategics who are coming into the market are kind of wringing their hands about it, but they just ultimately concede and pay the price because they need to get into the market. You're seeing players like Goldman come way down market to invest and take big stakes in companies that, a year or two ago, they probably you wouldn't even consider them to be players in it.
We see them
Goldman,
way more than we used to, for
banks.
sure.
Right? Yeah. I mean, I will tell you, they're in, and of their ilk are in virtually all of our kind of, high flying fintech companies. I mean, they've found a way to get in, paid the price, and it's a bit of a toehold. It's a cheap option for them in many respects, so that that they're playing this space, keeping an eye on these companies, clearly with an eye to buy these companies, at some point in the future. So negotiating governance provisions with those folks is always interesting. But look, I think it's clearly robust. I know you've got a question later on SPACs. I'll table that, but that's like the very, very clear indicator that the sector is pretty healthy when it comes to exits and an overall buy-in that there's a lot of room to grow in this industry.
There was kind of a backlog too, right? Like everybody saved up. Same thing. Like they weren't fundraising in Q2, maybe not at the beginning of Q3. They weren't going to market in that timeline either. And now everything's coming to market like Q4.
Yeah, part of that's tax driven, right? I mean, everyone on the sell side wants to get a deal done before taxes go up next year. I mean, so that is a huge driver in getting deals done before the end of the year for those who are looking to monetize. So I'm not so sure. It's partly that too, Kelly, but I also think it's merely tax arbitrage.
Yeah, pandemic or no pandemic.
Yeah, right, exactly. We'll be looking at that anyway, which probably leads into some of your next questions.
Yeah, no, I guess the other question I had, sort of that's related to M&A is partnering. And so, maybe I could start with, Noah and Dee, and get your perspective, but anyone else can join as well. In terms of, the incumbent banks and, sort of the FinTech, companies, sort of how much partnering is, going on, what are the scenarios where you've seen it make sense, and sort of what are the, kind of pitfalls that someone who is sort of considering entering a partnership with an incumbent bank or a FinTech, what's your perspective on what they should be looking out for?
Yeah, I think if we group incumbent banks and just incumbent financial institutions into one, I think over the last year or two, you're seeing a little bit more of the strategic acquisitions from previously strategic investments and partnerships. So my former employer, Laurel Road, which was a student loan refinance company, was acquired by KeyBank. Obviously, you had the Visa acquisition of Plaid, American Express acquiring Cabbage, the Lending Club and Radius merger. So I definitely think there was this period of gestation, testing the water, but now seeing some of the larger organizations kind of pushing the chips all in terms of looking at bringing these companies under their own hood. Where I think we are still seeing a healthy amount of partnerships, and again, this is from my capital markets lens, is larger and mid-sized and larger banks acquiring assets, financial assets from some of these fintechs. So just broadly speaking, fintechs tend to be capital light and asset heavy. They've done a wonderful job at manufacturing, creating assets, while as incumbent banks oftentimes are the opposite, asset light and capital heavy. I think there's a really interesting segment. If you look at the banks, ranked asset size 550 to 500, so those mid-tier regional and super regional banks, they represent roughly $3 trillion of assets in the banking sector, and are severely underrepresented on their balance sheets in consumer and small business assets. So even if you were to see a 5% or so increase in those banks' allocations to consumer or small business loans, that's unlocking an additional $150 billion worth of funding capacity. And I think we are seeing more and more of these types of banks who don't really have the cost structure to originate and manufacture these loans themselves, but are looking for financial assets, working with these fintechs to purchase these types of loans.
Yeah, and Dee, just to I'd like to get your perspective on it. I mean, just to be clear, I mean, short of acquisitions, I mean, have you seen, sort of, incumbent businesses, choosing to do more with fintech companies and outsource, certain parts of their functions to fintech companies, short of an acquisition?
Yeah, look, in a lot of ways, the fintech companies have become sort of the innovation arms, or the product development arms for a lot of the banks. You've got, I guess there are many categories, but to oversimplify, there are two categories, right? You have the enabling banks, the bank corps, the meta banks, Sutton, Evolve, Cross River, really that enable fintechs to go build large finance. And the examples would be folks like ourselves, Affirm, others, that to then basically go build product for consumers. The banks really then provide the payment rails, the access to the Federal Reserve, ACH, debit card processing, the regulatory and compliance elements around federal law, compliance. So that partnership has been a bang out success. There's a whole category of these fintech banks that trade really nicely in the public markets, and they create very strong, robust, recurring non-interest income from a public market perspective. Now we're also seeing that you've seen really crypto become a protocol for the transfer of digital assets. But that same level of technology build is now coming to even the protocols by which the banks communicate with each other. So there's, this element of banking as a service is being democratized even more. It was democratized for the last 5 years, but what we're seeing is that more and more, new startups are coming in that make it even easier for anyone to move payments from consumer one to consumer two. And what that allows is it allows places where you wouldn't expect financial services to be delivered for financial services to exist, right? So the best examples are, Uber and Lyft and the ride-sharing companies. They have massive amounts of payments infrastructures that are embedded inside that product that make it really instant for you to, often settle a ride-sharing a transaction, if you will. So that type of, we're in the middle of that, thinking about, hey, we've built amazing technology for the front end. All of it is microservices. Could others use it? Could others leverage it? And in terms of the bank and fintech partnerships, that's really where the most interesting technology work is being done to make the ability for Cross River and Moneyline, or Moneyline and MetaBank to speak become, a exercise that takes a couple of days, as opposed to today where it takes 6 months to a year and a 30 to 40 person team to really integrate it at scale. And that's, that'll be interesting. The flip side is, of course, that these are highly regulated businesses where you're dealing with consumers. There's fraud, there's chargebacks. There's a lot of, subject matter expertise that comes to deal with that at scale. But I suspect that over the next couple of years, even that will have really interesting solutions that are automated, that are consumer friendly, that'll be coming to market.
So I want to leave.
You're seeing that too in the insurtech space too, right? The insurance companies actually even less so than the banks are innovating at all, and they're basically partnering with emerging companies to provide everything from underwriting support and data collection to all the payment processes that are involved in that, claims management, et cetera. So they're relying almost exclusively on partnering or buying insurtech companies. None of them are building it on their own.
Great. So I want to leave some time for Q&A, but I did want to, we are a couple days away from an election, so I don't think any sort of webinar around this time would be complete without talking about the impact or potential impact of the election. And so really this is a open question to anyone who would like to take it. In terms of what the regulatory and business environment is going to look like for FinTech, post-election, do you expect changes, with things like, just as an example, data privacy, sort of how will that be impacted, post-election? How will the business environment be, impacted, post-election? So anyone who wants to sort of take the impact of the election, that'd be great to hear your comments.
Well, I'll start off. I think the biggest tip of the spear here is really the posturing of the CFPB. The CFPB was set up right after Dodd-Frank. And Dodd-Frank, one of their principal goals there was to really allow the innovation around data access. So even up to a couple of weeks ago, there was rulemaking commentary that was requested by the CFPB around data access. This relates to how fintechs use bank transaction data, how the banks, the incumbent financial institutions, have to cooperate to make that data available. So I think we'll continue seeing progression of that despite what happens in the elections. I think it is a bipartisan maneuver. Ultimately, it was started in Dodd-Frank. The current administration kind of progressed that a little bit. So either way, it'll be interesting to see how the CFPB postures. Really the idea of who owns that data. Is it the incumbent financial institution? Is it the consumer? Or is it the fintech? And that'll drive a lot of the second derivative impact on how products are built, how consumers are interacting with it.
I would say from our perspective and our primary regulator being the FDIC, that whether it's a blue wave or red or mixed, I think there does seem to be tailwinds regardless for those who are involved in responsible, non-predatory type lending. The opportunities that are available for small businesses today are cheaper and consumers cheaper, more efficient than they were several years ago. And so long as there is this continued focus on providing a true economic and positive benefit to those end users, both the FDIC and the OCC have been overly supportive of the bank partner model and working with fintechs and really driving towards clarity on some of the looming issues that have been outstanding for the last 5 or so years. So, despite what does happen in the election, I think we do remain confident that there will be continued support for responsible lending.
Anyone else?
Look, I think at a macro level, I think certainly if the Democrats come in, there's going to be, a heck of a lot more pressure on the big banks to ensure there's going to be new regs, which I think drives more opportunity for fintech companies overall to help the banks solve some of the problems that they might be facing. So, I don't think necessarily additional regulation from a fintech industry perspective is necessarily a bad thing. It may be an opportunity for additional innovation.
Brittany, if I could jump in here for a minute, we're going to try to wrap in just a couple of minutes. But being, Tech United New Jersey, one of the things we think a lot about are the differentiating advantages or disadvantages of the region. And I'm curious, from the panel, why is this region particularly suited for fintech, and if so, why? Cabbage is in Atlanta, Plaid's in San Francisco. We talk a lot about fintech around the New York, New Jersey area. So where do you think the opportunity is for us? Maybe I'll start with you, D.
Look, I think at the end of the day, Wall Street's here. A lot of the incumbent financial institutions are here. New York showed its mettle recently with some great companies in New York and New Jersey. You've had great successes in the insurance space and fintech. The ability to partner that we've talked about, right? With the largest institutions on the wealth advisory and wealth management side. All of the routing of American financial services still in a lot of ways goes through the Northeast. The talent is amazing here now. A lot of the talent argument has been democratized. Talent's everywhere now, right? So really, I think from a regional perspective, in certain ways, you could start a business anywhere, but the ability to be in the Northeast allows you to have access to some of the best partners and some of the best, really go-to-market strategies.
Yeah, New Jersey, should mention, rich with talent, and I think hosts most of the financial transactions as far as servers go in the country. Kelly, what are your views on the regional advantage?
There's just this obvious, proximity to New York and accessibility to anywhere, major, hubs. I think we have healthy industry here, even beyond the, fintech at the end of the day is, I think where it's going is kind of fintech for everything. And the intersection between banking and financial services and all this enabling technology, it's really fueling so many other sectors, and many of those sectors exist right here. The strength of many of these sectors exists right here in New Jersey too, right? Healthcare is a big one. So, I think it's a great place to be for innovation and for access. And, a lot of the people with these ideas and that are making their marks in these areas live here, which I guess gets to the talent point, right?
Yeah. I know that go ahead, Andy, go ahead.
No, I was going to say, look, I think that the biggest advantage for the region in fintech is now obviously the indigenous financial services sector, which is still, globally dominant. But what we've done as the region is we've caught up on the tech side, right, over the last 5 or 6 years or longer, right? And there's been an influx of tech talent that is industry focused that these companies can draw from, which was not the case 10 years ago for sure, right? We had the financial services industry, but it was old. It was the legacy, the legacy businesses and legacy institutions. But now you've got a culture that's completely changed. Where the massive influx of young talent looking to drive innovation here.
Yeah, excuse me, totally with you on that. No, I'll give you the last word on the advantage, especially since I know we draw you across several rivers to join us in New Jersey, which I know you really love doing.
It fits with the name, but yeah, absolutely. And I think beyond being regulated by the FDIC, we report to the State of New Jersey Department of Banking and Insurance, and I think our relationship with them over the last decade or so has been really wonderful and constructive. And we've always found it really first and foremost to be a pro-business environment to be operating in. And I think with organizations like yourself and others within the state of New Jersey, really supporting our corporation's growth. So long as, fulfilling our mission of helping consumers and small business around the country has been, just overwhelmingly positive over the years.
Awesome. Well, we really appreciate all of your involvement with Tech United New Jersey. You know, hopefully, regardless of what happens, we see this industry. I mean, Dean mentioned the democratization. You know, Andy's leaned a bunch on the acceleration and adoption, especially caused by the pandemic. So I think we're seeing a lot of interesting opportunity here, and really appreciate all your involvement with Tech United to bring more power to the people in the community of Tech United to enable some of these ideas. So thank you so much for joining us today. Rini, thank you for guiding this discussion. Again, thanks to Cross River and DLA for sponsoring the discussion. Really, really appreciate it. D, I thought maybe we lost you, but I know you've got to bounce right around this time. So we're going to close it anyway. So we'll end again just because it's, you know, it's a rainy day. I'm not feeling that good. We'll end again with the high five. If you're at home, you could stand up. You'll feel weird, but you do it with us. You're here with us in spirit. In the count of 3, high five. 1, 2, 3. Boom. Thanks everybody so much for joining us.
Andy,
Really appreciate
you're the
it.
worst.
I know. Low five.
Yeah,
Right.
yeah. Throw a baseball at the computer, whatever. Thank you so much for joining us. Really appreciate it, everybody. We'll see you at the next show. Thanks a lot.
Bye.
All right. See you guys.
Bye, Dee.